Welcome to the Weekly Take and a special extra edition with an update on the state of the economy and market outlook. I'm joined by CBRE's new global head of research and my longtime friend, Dr. Henry Chin, who recently relocated from Hong Kong to our Dallas headquarters. And he steps into the shoes of one of our longtime friends, guests, and our most frequent guest, I might add, Dr. Richard Barkham, who's retiring from CBRE. Henry will bring his worldly perspective to the show periodically throughout the year as the economy changes and we have new issues to discuss. Henry, my good friend, welcome back to the show and your first visit as the global head of research. We hope to have many more. Henry, welcome.
Thank you, Spencer. Thank you for having me here to join your fantastic podcast.
So, Henry, we are talking in an economy which has been a little volatile, to say the least. We have tariffs, we have interest rates, we have inflation. In a nutshell, Henry, how do you see the economy today?
Well, everyone is nervous about what the traffic is going to do based on the policy on the tariff. But nevertheless, when we come back to real estate, we do see there are clear shift in the sentiment over the recent weeks. And Spence, you can see on the newspapers, on the news outlets, people are very excited to talk about all the different things. But actually, I was pretty calm over the past few weeks. The reason I really want to highlight here, Spence, is real estate doesn't change on a daily basis.
Well, I completely agree with that. On one end of the spectrum is fear and emotion. And on the other end of the spectrum is math. And over the long term, math wins. So I'm completely in sync with you on the macro. How does that apply to the micro? How does that apply to our investors who may have some of that fear given the volatility?
Spence, lots of thinking about it. Real estate always had the two fronts. One front is talking about the occupier market, the space market. The other part is the capital market and investment market. Both sides are interlinked, right? So let's talk about the space market, occupier market sentiment. I have to say, over the past quarter, the leasing activities was superb across all the different asset classes. It was, to our surprises, office, retail, logistics, and leasing momentum has been strong. But over the last few weeks, we do see some occupiers are continuing to move forward to close the deal because they think, well, the real estate doesn't change on a daily basis. But some occupiers particularly are putting their decisions on hold until they have a clear vision. And therefore, going forward, we are expected to see some more renewals than relocations on that part. But when you are talking about the occupiers, the tenants, what are they looking for? It's pretty much on the one thing, common trends across the three asset classes is a flight to quality. So office occupier want to pay the best quality in the offices, retail doing the same, logistic are doing the same thing as well. And so therefore, if you look at the space market for now, probably if you're smart occupiers, I will start taking the advantage for now because there's a volatilities, less competitions. So therefore, you probably can get a better deals to secure your leases. And for the capital markets, investors is very interesting. Particularly the 10-year treasury yields played a key role, Spence. It was 3.9%, now up to 4+%, mid 4%. For the investors, it's super hard to underwrite the deals for now. If I am the asset owners, I probably will not try to sell the asset in a rush because it might not be the good time to dispose the asset if you can hold on to it. But if you are smart investors, there are so many interesting strategies. It's a vintage time for you to thinking about it. Number one, talk about credit. Given the credit volatilities, the rate volatility, if you have the credit funds, particularly for bridge loans, prefer equity strategies, that's a perfect time for you to tap into the spaces. Number two, public to private. You can see the REITs are trading at a severe discount, but private market remain relatively stable. And we do believe real estate is in an attractive pricing point of view. So therefore, public to private will be a fantastic strategy to deploy it. The third one, if you're the core investors, Spence, I want to look at long WALE assets because you can avoid those volatilities. Long WALE asset can help you to navigate through the storm.
Great. Well, your ideas and mine are Almost always in sync, and they are once again, Henry. But I would also say that given the volatility, as you said at the beginning, use that to your advantage. And I think you said use that to your advantage from an occupier perspective. I'd spin that to the investor perspective. You gave a couple here about the credit in the public markets, but I think there's certain areas such as border industrial, port industrial that are screaming buys given some of the fear factor and over the next decade. And if you're industrial, you really need to have that kind of longer time horizon. Trade, while it may be choppy today, is likely to be much better tomorrow.
And Spencer, the other things, I always love to hear your view as well, but sometimes we are very contrarians, right? So do you remember during the COVID days, we're thinking about offices here to stay. People should actually start looking for the offices. I'm still very contrarian now. I'm still thinking about the office market in those gateway cities, good qualities. We have reached the bottom. The leasing is coming back. The pricing become relatively attractive. So investors shouldn't be afraid to come into the office sector as well.
Well, listen, amen. I mean, once again, Henry, we're in sync because what I've been suggesting, Henry, is that we have two basic categories of investors. We've got 10, but I'll break it into two: high net worth individuals and institutions. You know who's been backing up the truck, to use a very technical American term, on office? High net worth individuals. And they've been doing it in two categories. Number one, they've been buying the highest quality stuff for a very high yield, which you can't tell me that yield won't come in. And the second is they've been at the forefront for some of the older office to convert. I think the institutions have waited because they're concerned about having too much office on their existing portfolios. And bringing the O word into investment committee is probably a little bit too scary for many of them.
Spencer, it's quite interesting. The trend you are seeing, you're describing in the US is 100% aligned with what we are seeing. I was seeing before I moved to the US in APAC. The high net worth individual investors, they are so sharp, they're so through, they're looking for the opportunities again to that. They also don't need to go to investment committee processes. So therefore, let's see. I do think about the cap rate for the offices will compress at some point of time.
So let's look at your outlook here. I just got our latest house forecast, Henry, and our house view as the economy slowing this year and next, and maybe picking up just a little bit next year. But we do have interest rates coming down in the United States over the next 18 months to under 3%, the short end of the curve, long end of the curve terminating around 4. What's your point of view, Henry?
I think our house view is quite balanced. I won't say optimistic or too bearish for that. It is quite
Yeah.
balanced because we have never seen this kind of tariff implemented in a recent economical history. And so therefore, given all of those uncertainties we're coming through, we are expecting to see the weaker growth for GDP and for 2025 interest rate. It's going to be around 3 cuts and for that policy rate. But I have to say, Spence, over the last, every day I was watching news. Every day I was watching the policy changes. It's quite fascinating to see the tone coming from the government has changed quite substantially. So therefore, people were overly bearish over the last 2 weeks. But now people realize, actually, we might come up with a better, stronger outlook as well. So therefore, as of now, the consensus seems to be overly toward to the negative side. The model cannot forecast the policy changes. The models cannot forecast humans' behaviors. And all those negotiation is very, very hard. So given all the different uncertainties we're having, so that's why I think our view is quite balanced.
So, well, let me ask you one more research data question. What are you looking at today to give you the best forecast for the future?
It's very interesting. I do look at VIX a lot as well. I also look at the spread as well. So those kind of data indicators is actually give you some feelings, temperatures about the financial markets. But also I pay extra attention on the monthly basis of job numbers as well, Spence. The job number is crucially important. And sometimes we should also looking at those softer indicators like traveling, consumer sentiments, also open table bookings statistics actually give you the feel of the real economies. It's always a two-sided story. People can be so overly negative. But as of now, I think the consumers still holding out relatively okay. And the job market are still relatively resilient as well. So therefore, there's no reason for us to be overly bearish, Spence.
I'll give you one other data point, and it was interesting because in the depth of the uncertainty crisis, the volatility, the inflation reports came out, both the CPI and the PPI, and you know what? They came out good, and it was like nobody noticed. because there was all this other exterior noise.
Yeah, I agree. And about 10-year treasury is something we need to watch out very closely as well. I think because when you look at the US 10-year treasury, the biggest holder are Japan and mainland China. So therefore, those something we need to look into that. Sometimes from the rationale point of view, we don't see that's an issue. But for the political policy point of view, those two governments, what they're going to do is something to worth watching out for.
So, Henry, I remember the first time I met you. It was in Tokyo. It was in 2014. I saw you do a presentation, and I came up to you right afterwards. I said, wow, this is it. This is how it's done. And here you are today. You just became the global head of research. So I knew it was well-deserved 12 years ago, but congratulations, Henry, on your new position.
Thank you, Spence. Actually, funny enough, it has never been my career plan, but actually I review my career over the past 20 years. I spent 10 years in the UK, and I spent 16 years in Hong Kong. And I was so lucky to have this opportunity to come to the US to learn for all of you and to lead this great research team as well. I think we are one of the best, if not the best, we are one of the best for the commercial real estate research house globally.
Let's go with the best. How about that?
Oh, that's good.
Yeah. Well, on behalf of the Weekly Take, what a pleasure to be with my longtime friend and colleague, Dr. Henry Chin, our new global head of research. Great job, Henry. Looking forward to many more.
Thank you for having me here, Spence.
So on behalf of the Weekly Take, thanks again to you and to everyone in the audience. Henry will return to the show throughout the year to share his outlook and, let's face it, interesting times for the economy and our business. We'll have our regularly scheduled episode coming next week, and we look forward to you joining us then. And as always, you can find more on our website, cbre.com/theweeklytake. I'm Spencer Levy. Be smart, be safe, be well.